Hi, this is James Shug with Westpac London's end of day report for Monday the 4th of March. Sentiment started off in Europe with a negative bias. We had reports out of China suggesting that there was going to be a closer scrutinisation of property market deals, that there would be tighter enforcement of property market regulations and possibly even higher taxes related to the sector. That saw property shares in particular in Asia, in China, fall quite sharply, but there was a flow-on impact into equity markets more generally, and that certainly impacted Europe in the early part of the session. Had a little bit of circularity displayed when the European Centix Investor Confidence Survey for March, it fell from -4 to -11. That was the weakest reading for the year so far. Now, Centix survey big name investors about their confidence, and of course when investors are pulling out of the market, they are presumably less confident about the outlook. So when they get surveyed and they say they're less confident, it doesn't necessarily make sense that the equity market should fall on that news, but nevertheless it did. Although later in the day, the comments from Fed Vice Chair Janet Yellen saying that the Fed should continue with its $85 billion per month bond buying program, but with an eye to tracking possible costs and risks from the unprecedented program. Those comments kind of offset a feeling that had been coming out of the Fed, or from some parts of the Fed, including perhaps in the recent minutes, that there was a growing body of opinion suggesting that maybe the Fed should be pulling away from its stimulus fairly soon. So the China story was a negative. The Centix Investor Confidence result was a negative, like probably shouldn't have been, but there was some offset from the Yellen comments. We had a stronger New York ISM survey, but it's not really closely watched. And the Bank of England reported the latest quarterly lending results. They showed that although the 40-odd institutions that are participating in the Funding for Lending scheme had, which was introduced in August last year, although those banks had borrowed cheaply just under £14 billion, lending to households and businesses, for which that cheap borrowing was intended, had actually fallen by £1.5 billion as at the end of 2012 compared to the end of the second quarter of last year. So in other words, in the 6-month period in which the program was introduced, banks borrowed lots cheaply, but lending actually fell. Now the Bank of England says that there's a seasonal issue in the last quarter, but it was actually just 3 banks, Lloyds and RBS, both partly government owned, and Santander, that accounted for nearly $15 billion less lending to households and businesses, more than offsetting pretty much gains at the other institutions. And there are special factors related to those 2 institutions, but it's certainly a bit disappointing, I suppose, that we're not seeing a better result there. The bank argues that we don't know what the counterfactual would have been. Maybe the lending story would have been even worse without the Funding for Lending scheme, which of course was introduced as kind of an alternative to further asset purchases at the time, or it was seen as stimulatory but more targeted stimulus. So the bank's hoping that during 2013 more clear results will come through from that. The PMI construction in the UK fell from 48.7 to 46.8 in February. That was its lowest since, well, pretty much the end of the recession in 2009. So that was the data and news today. In equity markets, very minor changes today. The FTSE closed down 0.5%, but the French market was up 0.25%. The Germans down 0.2%, Spain up 0.7%, and Italian market was down 0.9%. Okay, some of those reasonable moves, but compared to some of the big swings we've seen of late, it was a fairly mild day. And as I say, a very mixed day with some up and some down. The Dow at the moment is down not even 0.2%, down 0.16%. It's at 14,066. Commodities, oil's off 1% today, $89.75 a barrel. Gold is unchanged at $1,572 an ounce, and copper's up 0.3%. The Aussie dollar at 1.016 at the moment, is at its lowest since, just looking at the chart, since July last year. Okay, and it's fallen pretty much 4.5 cents since its recent peak at 1.06 just after the start of this year. We've got the Reserve Bank Board decision Tuesday Sydney time, and then we've got the GDP numbers for Australia on Wednesday. So 2 local events to watch for down under. All right, I'll be back same time tomorrow.